Hey, this is Chris, and today I'm going to be sharing my thoughts on some of the risks to be aware of when investing in ETFs or listed products like ETFs, including managed funds or LICs. Now, historically in Australia, the first index funds were these big, broad, transparent, low-cost funds that tracked a big, broad index like the ASX S&P 200 or the S&P 500 in the US or some sort of index like that. And I think a lot of people think ETFs are all like this. But in fact, most of the new listings of ETFs aren't tracking these big, broad market indices. They're nowadays tracking smaller indices or maybe not even tracking an index at all. You know, you may be able to understand what the underlying holdings are, or sometimes they're not sharing this information. And so there's a lot of differences actually between these products, and they're all still clumped within this exchange traded product or ETF grouping when they're talked about in the newspaper or online. So I want to share 4 things that I would look out for before investing in them, that you should be either asking the ETF provider or asking your advisor, because they can alert you to potential risks. And the first one is whether the product is open or closed-ended. Now, this is a pretty critical one because I think it's one of the huge benefits of ETFs traditionally is that they're open-ended funds. And what that means is that money can come into them and money can come out of them, but it leads to the ETF trading very close to the underlying asset values. And this is really important when you're an investor because you want to get in or out of these things at a fair price that reflects the underlying holding values at that point in time. One of the problems with some other listed products like listed investment companies is that they can trade a long way away from the underlying asset values. And this is probably most prevalent in LICs, where a lot of them trade at a 10 or 20% discount to the underlying assets. A lot of people argue that this is inefficient and actually gives you a great buying opportunity. In fact, I don't believe that at all. I think it just reflects the fact that there's such big fees in these products. People are discounting the future cash flows by the amount of fees. But in any case, it adds an extra risk for investors when you're buying an asset that really can vary from the underlying holdings. And so looking at whether an investment product is open-ended or closed-ended, I think is one of the first questions you should be asking when looking at ETFs, listed managed funds, or listed investment companies. The next question is whether the product is rules-based or not rules-based. Now, traditionally, rules-based ETFs tracked a broad market index. Like I mentioned before, the ASX 200 is a very well-known one. And the ASX 200 basically has a bunch of rules that allows for what companies come into the index, what companies go out of the index, how companies get up-weighted or down-weighted. But this sort of natural evolution of the index is actually how you capture the fantastic long-term return of the market. And all of the studies about market returns have looked at the performance of that index over a long period of time. So the other group of ETFs, and there's a lot more of them these days coming out, that are not rules-based. Now, these are more discretionary funds and often active ETFs or active listed managed funds, where there's a fund manager picking what stocks to come in and out. And the risk of this, and I've discussed it lots of times before, is that most fund managers, as much as they're very smart and they have fantastic skills, they're not able to beat the market by picking these stocks in the long run. And ultimately, the costs of these funds erode any benefit from the stock picking skills over the long term, and it makes it very difficult to earn the market return. So knowing whether it's a rules-based or not rules-based is another question you should be asking. For not rules-based products, so ones that aren't tracking an index, another question to ask is whether they're transparent or not transparent. And what I mean by this is whether they actually publish the underlying holdings on a daily basis. So some of the active ETFs these days don't want to actually share what they're investing in because that's the intellectual property of the fund manager. And so they only publish the underlying holdings on a very periodic basis. It might be monthly or something like this. That makes it very difficult as an investor to actually understand what you're investing in because it may change within that period. And so you're actually buying into a black box. You don't actually know what's in the holdings. So finding out whether it's a transparent or not transparent fund is another question to be asking. And then the final one is whether the fund uses any sort of significant leverage or derivatives to provide its return. Any sort of leverage or derivatives adds risk. It adds risk both from a financial perspective because it leads to higher gains but also higher losses. But also it comes with an extra cost and it comes with counterparty risk. you're ultimately trusting that whoever's providing that derivative or option is going to be good for it if they have to pay out. Now, in my mind, a lot of these higher cost products that are out there that have leverage aren't great long-term investing options, and a lot of the data supports this as well. Ultimately, the costs of leverage and also the fact that they're compounding daily returns really makes it difficult to earn a great long-term return from these products. And that's why I think it's a good question to ask and generally something to avoid. So in summary, when we're doing our ETF research for Stockspot clients, there are a few things we're really focused on, and we tend to pick ETFs that are, first of all, open-ended, which means they're always trading at the correct asset value, that are rules-based, so there's a great long history to understand how that asset's performed, and you're always going to be recycling out of the bad stocks and into the good performing stocks, that are transparent, so you always understand what the underlying instruments are, and finally, products that don't use significant leverage or derivatives to actually achieve a return, so that omits a lot of the risk around counterparties, amidst the costs of leverage, and amidst the magnification of returns in the short term. And there's some of the things I think you should consider when picking an ETF, and some of the risks you should try and avoid if you want to be building long-term wealth.